Happy Thursday out there, Team 42. It's your skipper here at Darius to present our macro minute for Thursday, March 13th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what is consensus overlooking regarding U.S. fiscal policy dynamics? Our answers are a quiet day on the economic data and policy guidance fronts affords us the opportunity to unpack a key global macro force that we think is grossly misunderstood and will likely contribute to cross-asset volatility in the months ahead. Specifically, we currently anticipate fiscal retrenchment will slow U.S. growth faster than consensus expects over the medium term. We believe investors underestimate the extent to which expansionary fiscal policy contributed to robust nominal GDP dynamics in recent years. Specifically, nominal GDP grew 5.8% in 2023 and 5% in 2024. We estimate expansionary fiscal policy directly contributed 210 basis points, or a fifth of that growth. Contractionary fiscal policy via DOGE may cause the fiscal impulse to swing from a 100 basis point per annum tailwind to a 100 basis point headwind. That will effectively subtract 2 percentage points from nominal GDP growth. All told, if President Biden intends to follow through with our strategy of kitchen sinking President Biden's artificially inflated U.S. economy, the Fed must step up and proactively offer expansionary monetary policy to offset contractionary fiscal policy, specifically QE. Each day of inaction moves the U.S. economy closer to a deeper than necessary slowdown in growth and financial markets closer to a global refinancing air pocket. The latter outcome is far worse for your financial health. The global debt refinancing clock is ticking, Jay. Tick, tick, tick. And before we transition to our 42 Macro dashboard, I just wanted to highlight a couple of things from our 42 Macro Fiscal Policy Monitor, specifically as it relates to the expansion of the budget deficit and how that's contributed to the growth of the U.S. economy in recent years. Now, obviously, we've had a resilient private sector economy as well, as evidenced by 8 consecutive quarters of real final sales to private domestic purchasers being at or above the trailing trend, the pre-COVID trend of about 3%. But we also had a lot of fiscal largesse that was being pumped into the private sector. You think about a company like a Palantir, you think about a company like a SpaceX, people who sell things to the, big things to the government. You think about defense contractors, et cetera. We were pumping out a lot of money from Biden's, into Biden's artificially inflated economy. So you look at the last 3 years, starting in 2023, the federal budget balance declined by $365 billion in 2023, which means the deficit is rising. The deficit grew $250 billion in 2024. And on a annualized calendar year-to-date basis here in 2025, the federal budget deficit is growing by $581 billion. That's a growth rate of the budget deficit of 26% in 2023, 14% in 2024, and 29% here on an annualized calendar year-to-date basis here in 2025 with data through February. For starters, this is nuts. This is why we have a 9% budget deficit to GDP right now. And we obviously got we take an Elon Musk chainsaw to that number a couple of times to get to Scott Bessent's target of 3% in terms of the deficit to GDP ratio. By the way, spoiler alert, I don't think they're going to get anywhere near that. But we do think we are going to see a pretty substantial fiscal retrenchment here in the U.S. economy over the next, let's call it 4 to 6 quarters. It's not all going to hit in 2025, but over the next, let's call it 4 to 6 quarters, say by mid 2026, you're going to talk about transitioning, basically a 200 basis point headwind to growth to something that looks like a 1 to 200 basis point, 200 basis point tailwind, my apologies, to something that looks like a 1 to 200 basis point headwind. And that's going to be significant as it relates to the impact of that on the private sector economy and sort of reining in all that fiscal largesse and obviously is likely to slow growth much faster than what we can observe in current GDP estimates, what we can observe in micro data in terms of sales estimates and earnings estimates for, kind of S&P type companies. So I want investors to be very aware of this risk. If you're not tracking fiscal policy dynamics as closely as you're caring about the Fed and what Jay Powell says, every, 6 weeks, you're not paying attention to everything that matters to global financial markets and the U.S. economy. So I want to make sure that, you can come get this information in real time when our clients are getting exposed to it. So the last thing I'll say is transitioning to our 42 Macro client community. I'll just wrap up with a comment from one of our subscribers. This one's titled 42 Macro Lifetime Subscribers. Darius Dale, thanks for all the hard work and research you provide to your subscribers. I've only been with 42 Macro for less than 2 months. Already, it has paid off, and I've avoided the drawdowns in the equity markets. Your KISS portfolio construction is fantastic and easy to follow. You have a lifetime customer here, and I hope you keep 42 Macro around for decades to come. Thanks again, and always looking forward to your morning note. I just want to say I'm super humbled by that incredibly kind, feedback. This is why I get out of bed. This is why we started this company. We wanted to narrow the information asymmetry on in terms of what the signals that the risk management overlays and the depth and breadth of research that our clients on Global Wall Street, of which we have many, it's roughly a little bit more than 50% of our business are institutional investors. We want that. We want the information that they are able to act on and inform their trades with. We want that same quality and breadth of information to be available for folks on Main Street like myself. I grew up on, I don't even think I even grew up on Main Street. It's behind Main Street, across the train tracks and in the homeless shelter, but that's neither here nor there. That's the ethos that we're building this firm with. And this is exactly what we, quite frankly, expect to see, because we are delivering the kind of value to our clients that is, kind of represented in this comment. But we are nonetheless incredibly grateful, incredibly humbled by the growth and by the positive feedback we continue to get from our clients. So just want to say thank you to the client. Thank you guys for always listening to these rants every day. I hope you're learning a lot. I certainly am. It's a very interesting time to be in macro. So grateful to be helping lead the charge on I am grateful to be at the vanguard of thought leadership for a lot of investors, for thousands of investors around the world. It's a real humbling thing that, when you consider I grew up on the wrong side of the train tracks in the homeless shelter and occasionally in a Chevrolet Astro van. So appreciate that. Appreciate everyone. We'll catch back here tomorrow. Cheers.